Today, I'm going to try and answer one of the most common and persistent questions in the entire Bitcoin space. Where is Bitcoin likely to top out this cycle? Now, let's be honest. Most Bitcoin price predictions are pretty much pointless. They're often closer to fortune telling than they are to any sort of reliable data driven analysis. Wild guesses, moonboy charts, or vague trend lines aren't going to cut it. That's why today I want to take a different approach. Rather than rely on speculation, I'll walk you through six of my favorite metrics, all of which have a strong historical track record of signaling previous cycle tops. These indicators aren't perfect, and no indicator is, but they've each nailed major Bitcoin peaks in the past with impressive accuracy. So let's jump straight in. What you're looking at here are six colored lines, each representing a different on chain or market derived estimate of where a Bitcoin cycle top might occur. They're all technical in nature, and to be honest, each one could have an entire video dedicated to just breaking it down. But for the sake of this overview, I'll walk through each one fairly quickly to give you a sense of what I'm looking at and why they matter. First up is the terminal price, which is the light red line. This one's a classic. The terminal price is a theoretical upper bound for Bitcoin based on cumulative value transferred across the network and Bitcoin's age. It's been incredibly reliable in past cycles, accurately marking where the top has occurred. Think of it as a sort of mature terminal ceiling for Bitcoin price action. When price reaches this level, historically, things have gotten overheated. This metric alone makes a strong case for keeping it on your radar. Next is the coin value elevation, or CVE, which is the dark red line. Now, this is my own custom metric. It's a time-scaled exponential extension of the coin value days destroyed metric. Basically, it tracks long-term price ceilings by adjusting for Bitcoin's age and how much value is being moved by long-term holders. What I like about this metric is that it dynamically adapts to longer cycles, stretching upward in a way that reflects maturing market behavior during euphoric phases. The coin value elevation often captures the full extent of late cycle mania when the FOMO kicks into overdrive. Next is the 5 times balanced price, which is the yellow line. This one might sound a bit abstract, but it's incredibly valuable. The balanced price is itself a blend of the realized price and the terminal price, essentially mixing current investor cost basis with historical network valuation. When you multiply it by 5, you get a speculative top projection that adjusts for both long-term network fundamentals and short-term market exuberance. It tries to estimate what a reasonable overvaluation might look like. Again, very useful during late-stage bull runs. The fourth line is the 4 times adjusted realized price and is shown in green. This is a refined version of the traditional realized price multiple. Here, we use a corrected realized price, one that factors in things like the spent output profit ratio and transaction volume, and then multiply it by 4. It smooths out the raw realized price metric to give a more accurate multiple that reflects when the majority of coins are being sold at high profits. It's essentially a heat gauge for network-wide profit taking. The orange line is based on a 4.5 times multiple of the original coin value days destroyed metric. It's a way of measuring the destruction of long-held coin value when coins are moved. When coins that have been dormant for years are suddenly being sold, this metric flares up. Multiplying it like this gives us a historical alignment with major tops, where long-term holders finally capitulate into market euphoria. Finally, we've got the delta top. This one is a bit more niche but powerful. It's calculated as 7 times the difference between the realized price and a time-adjusted average market cap. What makes this line so interesting is that it tends to align very well with psychological blow-off tops, those euphoric, irrational surges that push Bitcoin far beyond fair value. It always paints a very bullish picture, and for 99% of the time it stays way above Bitcoin's price. But during those textbook blow-off top patterns, it regularly gets tagged before an inevitable crash back down. So now that we understand each line, let's look at what they're showing us today. On the right-hand side of the chart, you'll see the price levels associated with each of these indicators. They currently range from $139,000, which is the prediction from the coin value elevation line, all the way up to $211,000, where both the 5 times balance price and delta top converge. That's quite a spread, but that's normal in periods of choppy range-bound price action like we're seeing now. This divergence doesn't mean the metrics are wrong. It just means the market hasn't entered the euphoric parabolic phase yet. When that moment does come, we often see these lines begin to converge. A great example of this was in the 2017 bull run, where all these indicators started clustering tightly together just before the cycle top. Now, you might be thinking about which one of these indicators should you trust the most, and here's the problem. If you only follow one line, you run the risk of selling too early and missing out on further gains, or selling too late and riding it back down. That's why I prefer to use all of them together. To get around the problem of conflicting signals, I've created a merged average line. This is the white line on the chart. It's the mean of all 6 top indicators, giving us a composite view of where a macro top might form. Right now, that composite value stands at $179,000. It won't be perfect, and of course, price can overshoot or undershoot it. But historically, this average has offered a very reasonable zone to begin scaling out, or at least preparing for a possible top. It gives you a framework rooted in data, not hype. Let's take a quick historical look to see how these indicators performed. Back in 2021, price touched the white line multiple times near the top. I've also added red backgrounds to the chart to make things clearer visually. These red zones indicate periods where Bitcoin's price was extended above multiple lines. The brighter the red, the more lines it was above, kind of like a multi-metric overbought signal. Go back to 2017 and you'll see the same thing. A strong confluence of indicators flagged the blow-off top perfectly. And even further back, in 2013 and 2014, Bitcoin blasted past some of these lines before the eventual collapse. But what's interesting is that even when price overshoots, the zones still act like magnets. They're strong areas of confluence that you can use to plan your exit strategy, rather than relying on gut feel or emotional decisions. If history repeats itself, or even just rhymes, we'll likely see all of these indicator lines begin to converge as Bitcoin enters its exponential phase. This convergence is something that's happened consistently in previous bull markets. During the earlier parts of the cycle, these models can diverge quite a bit, with a wide range of potential top estimates. That's normal when the market is moving sideways or still in the early stages of a rally. But once we get that parabolic, euphoric price action, the part where things get vertical, that's when these lines start to come together. And when they do, they tend to do it fast. Now, if we see Bitcoin's price touch the white composite line while it's accelerating upwards, that's when we'll have far more confidence in calling a macro cycle top. It's not just a matter of price hitting a number, it's about the context and behavior of that move. That kind of alignment, where multiple long-term metrics and market psychology all point to the same zone, has historically been a reliable signal that we're in the final innings of a bull run. The white average line isn't static either. It evolves with the market. In fact, it tends to rise very rapidly once the exponential phase kicks in. Take 2017 as a textbook example. In the middle of that year, before things really got going, the average white line sat at around $2,500. That made sense at the time, as the market was still consolidating and slowly rallying upwards. But once Bitcoin took off, and the full force of market euphoria kicked in, all 6 models surged upwards, pulling that average line with them. By the time we reached the blow-off top in December, the average had climbed to nearly $20,000, a staggering 8 to 10x increase in just a few months. That's why I'm not suggesting Bitcoin will top out precisely at $179,000. That's where the white line is right now. That number reflects what the average top might look like if we went vertical from this moment. But let's be real, it doesn't feel like we're there yet. Right now, the market is still uncertain. We're seeing corrections, hesitation, and a lack of the full-blown mania phase that usually precedes a true top. So while $179,000 is the ballpark today, we need to understand it's a moving target. If price chops sideways for longer and then launches, the top could come in a lot higher. If price accelerates sooner than expected, the models will adjust, and the white line might flatten out earlier. Timing matters here, not just price. The key takeaway is this: these models don't give us an exact number to set our sell order on. What they do give us is a zone of confluence, a cluster of signals that, when they align, provide us with a high probability environment that a macro top is near. The goal isn't to be perfectly precise. It's to avoid getting caught in euphoria or panic and instead take action based on rational, data-driven evidence. And so, while I'm not saying Bitcoin is definitely going to 179,000, I am saying that as this cycle progresses and we start to see these lines converging again, especially if price begins hugging that white average line, we'll be entering the territory where a top is more likely than not. Until then, patience is key. Let the indicators guide us, not the noise. So, to wrap things up, what you've seen today is that timing the top of a crypto bull cycle isn't about picking one perfect metric or relying on gut feeling. It's about confluence. When multiple trusted indicators start pointing in the same direction, that's when the picture becomes clearer. The power lies in the alignment, not in any one data point. That's where the white line comes in. It's not a magic number, and it won't give you an exact sell signal, but it is a reliable framework. Think of it as your roadmap for preparing an exit. When price starts to approach or stretch above that line, it's your cue to be alert, not greedy. And most importantly, history shows that the final stage of the cycle, the euphoric blow-off top, tends to happen fast and loud. During that phase, these indicators converge with uncanny speed and precision, giving you a rare window of opportunity. Recognize that convergence, and you're one step ahead of the crowd. That's the edge. In a game where most people react too late, your goal isn't timing the top to perfection, but being positioned before the crowd even knows what's happening. And that's all for today's analysis. Want more in-depth insights on today's topic? If you prefer written content, join my free newsletter for exclusive analysis. Click the link in the description. Thanks for tuning in, and I'll see you in the next one.